Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate, with host Glenn Sutherland.
Welcome to another episode of A Canadian Investing in the U.S. This week, my guest is Dominique Chenard. Dominic and I met online. We were chatting on forums, and she had a lot of information about all kinds of topics. I think we originally were talking about RSP investing, but I found out that Dominique is also, I don't know if do we use the word expert, but she's, at least compared to me, she is the superstar expert on whole life insurance. Dominique, maybe tell people a little bit about yourself.
Hi, so I'm Dominique. I'm from Thunder Bay, so up north in Ontario, if anybody's familiar, quite a ways from Toronto area. And so I work in the mutual fund and investment industry. I used to work as an accountant, and I'm a chartered accountant as well, so that's where my background's from, and I made the switch to financial planning. So I love working with real estate investors, everyday families, and all kinds of people, and I love helping them out.
How does participating in whole life insurance work? How is it different from life insurance at my work or term insurance?
Okay, so I'll just start with life insurance that most people have. So that's the one that you have through your work. For those of you that work and aren't quite self-employed real estate folks yet, so you might have a policy at your work which covers you for 1 or 2 years' salary if you were to pass away. So the way that works, that gets paid out to your spouse or whoever else is your beneficiary. And typically you have that to make sure your family can keep their lifestyle, cover any debts that you may have, so you're not leaving your spouse hanging, basically. Downside about that is if you leave your employer, then you don't have that insurance anymore and you got to go shopping around for a new one. Right. So that's the major downside there. If you know you're going to keep your job for sure till you're age 65, then that might not be a concern for you. And then term policy, similar idea. So you have it for 10, 20, maybe a little longer, about 20 years. And it's usually to cover a mortgage, cover some debts, and help out to cover part of your salary so that your spouse and your kids can maintain their lifestyle. Now, a whole life policy is quite a bit different. Whole life participating, I'll use it interchangeably there. So it grows a cash value. So you're paying a slightly higher premium, building a cash value. The death benefit goes up every year, just like your investments would, right? So like our policies, for example, have it growing 5-6% every year tax-free. And so the way they work is everybody, across Canada is putting in their premiums. They get invested, and then dividends are paid out to you through your policy. Yep. So that's what grows the death benefit of your policy, and then the cash value as well. So I wouldn't compare a whole life policy to, for example, your RSP or another investment that you may have. It serves a different purpose. It has a cash value, but you'll see the most benefit out of those policies after about 15, 20 years from now. So it's really a long-term thing. Primary benefit is it pays out a nice death benefit tax-free to your beneficiary, and then you also can access it for a loan, use it as collateral later on as well. But so in this case, the main reason we're bringing up whole life is because it can be used to pass on your estate if you have a few pieces of real estate. And that's a really big thing I bring up with clients, whether they have just a camp. Some people just have a camp, right? And they want to keep it in their family, but they don't realize that if they bought the camp 30 or 40 years ago, especially in a nice area by a lake, it probably went up in value quite a bit. And if you leave your children with that camp, they might have to fork out, $50,000 to keep the camp. And your kids might not want that, right? Or they might not have $50,000 lying around. So they might just have to sell it. And that's not what you wanted, right? So it's really used in legacy planning. And if you wait till you're 80 to realize that you want to structure it that way, it's a little too late for life insurance there. So it's really, I use it to talk to clients about what they want with their properties. If all they want is to just sell them and off we go, then it's not so much of an issue, but it's oftentimes a good piece in their plan.
You mentioned that you're able to borrow from the policy.
Yes.
Is that immediately?
Yeah, so depending on the size of the policy, typically around the 10, 15-year mark is when the cash value will be similar to what you put in. Okay. So it'll be similar to the premiums that you've been paying in. So you can borrow from that. Yeah. Now, after about 15, 20 years, depending on the policy, that's when the cash value starts being quite a bit higher than the premiums you've been paying, and that's when it's most beneficial to start borrowing from it. So the way you borrow differently than a bank is you're borrowing against yourself, borrowing against your own asset. So you pay it back when you want. There is an interest rate, about 5% charge on it.
But you're paying yourself. It's going to you.
You're paying yourself the interest, right, is what you're doing. Yeah. So depending on your goals, you might want to borrow it. I mean, I've met a client before that borrowed against it to buy an island.
Whoa.
That's kind of cool, right? You think people have to borrow because they're broke, but he was saying his RSPs are doing 12%. So it makes sense for him to borrow against his policy at 5%. And I'm like, absolutely.
Yeah, no. The first time, to be honest, that I ever heard about this, I thought, why would you put money into a whole life insurance policy just to give it back to yourself? And I know this, I figured it out. But the original thought was that it doesn't make sense. Why wouldn't I just put it into something else, like some sort of other thing? And instead of giving it to my own whole life policy and then borrowing it back, I'd be like, well, what's the point? But what I've learned from my minimal amount of learning that I've done is it's in a smaller scale, but it's almost what the banks do whenever you give them, put $1,000 into your savings account and then they can loan it out 10 times. This is a way that you can put money into your whole life policy, earn interest on it, and still have access to that money so that you can go and do something else with it. So it's like you're double dipping. You can take your money and use it twice. Does that make sense?
Yeah, I get where you're going there. And the main advantage is you shouldn't get a whole life policy just because you want to borrow from it later, right? But it's an option that you have. If you have a term policy or just, a normal term life insurance policy, there's no cash value in there. If you cancel your contract, it's gone. There's nothing.
Right.
If you cancel your whole life policy later, which is not usually the best thing to do, but if you cancel it in 30 years, it's worth a lot of money. So you get a big lump cash benefit from it, right?
Yep. And so actually, when you're applying for loans in the States, part of the application process is it asks you what the surrender value of your whole life insurance policy is, and they will count that towards income or money that you have as collateral for the loan.
Exactly.
They'll count it. Yeah.
Absolutely.
Why get whole life insurance? Why not just keep investing in my RSP and TFSA?
Yeah, so there's different reasons for all kinds of accounts, and I'm never telling people to do a whole life policy instead of investing for retirement, right? Those should be two separate things. So step 1, max your tax-free savings account. Now, tax-free savings accounts are great. You get to keep all the growth in your account, except you can only save so much money in there, right? So as most of you know, you can save about $5,000 a year, $57,500 in total as of this year. Yeah. So once you have that maxed out, then, you want to use your RSPs, but if you have a pension at your work, then you don't want to have too much registered money. So there's a lot of different factors to consider, right? So if you're a teacher or a government worker, you don't want to go crazy on your RSPs and have a bunch of registered funds, because then, it's going to cause a problem later. I'm not going to get into that.
Yeah. Oh, I know. You're preaching to the choir. I used to buy RSPs personally as well as just getting them through my work. Now I just get them through my work because I have a match program. And I try and preach this to my friends to put your money into a tax-free savings account, because then you still have access to it. Unless you're going over it, then you start finding other spots. But
that's right. Tax-free are so flexible. You can have one for a little trip account. You can have 20 tax-free accounts if you want, as long as your max is kept below 57,000. You could have a separate one for your trips, a separate one for an emergency fund, a separate one for retirement, and all be invested in different things. That's what a lot of people don't realize. They think it's just a high interest savings account that's tax-free, and no, you could be invested in all stocks and you're tax-free, right?
Right. And people always say, well, you're going to get taxed less on your RSP because it's done in the future when you're retired and poor. And I don't know about you, but I plan to be more wealthy than I am now when I retire.
And that's another thing, right? A lot of us are in that situation where I see myself having quite a higher income in 10 years and at retirement than I do right now. So RSPs are not the most optimal for me in the stage of my life right now. Yeah. But not everybody's there, right? So an example, someone that's at a job where they're making six figures and they know they're going to be pretty much there for the next 20 years and then retiring, then okay, RSPs might work for them. Again, if they don't have a big pension. So it's a very, case by case thing. So yeah, so I'll just go back to what I was saying. So there's your tax-free savings, there's your RSP, and then otherwise you've got unregistered investments, right? So, non-registered investments. So you got some investments in there, you make some money. Let's say you make some interest income that year of 10 grand and your account is doing quite well. So now you're taxed on that at your tax rate, which if you have a high tax rate, you're giving half of that money to the government.
Yep.
Now, in a whole life policy, if you got dividends on your policy, you're not paying anything. You're not paying any tax, right? So your policy's growing. Yep. You're not paying tax on the growth, and then it gets paid tax-free to your beneficiary, no probate fees, no nothing. So that's where if you're already using your tax-free, you're already using your RSP, you've got a good pension, you don't foresee a huge need for cash, and you're making more than you're spending already, then a whole life policy is a really good option to consider, especially when you're young and healthy, and especially if you're looking to have a real estate portfolio and not too sure what you want to do legacy-wise at that point.
What is a good amount to spend on life insurance?
So that's very different for every investor, and it really depends on your legacy goals. So if you want to pass a few properties onto your kids, then maybe think about what are going to be the capital gains on those properties. If you have no idea, then just talk to somebody that's familiar with capital gains. Typically, if you're familiar with them, about half of the gain is taxable, and then it's taxable at your tax rate. So the max you're really going to have to pay in Ontario would be just over 25% of the growth of your property. Now, what's that growth going to be 30 years from now? If you're 50 and you're looking to see where it would be when you're 80, we have no idea, right? So always foresee that there's going to be inflation and the need will be larger at that point. And like I said, whole life policy doesn't replace your equities or your real estate investments. I'm not telling you to ditch real estate and go and get a large whole life policy. I'm saying it has a piece in everybody's portly.
I totally agree. I have whole life insurance policy myself, and I bought it originally for my wife's sort of trade-off, so that we'd if something happened to us, the house would be paid off. That's what we did. And as we grow and I get real estate, and there'll be, like you're talking, probate fees, land transfer, whatever you're doing in the future, just to have money that someday my kids will get. And it actually has a beneficial side to it, because I think I pulled out $4,000 out of it last year just because I could. I don't know. I think it's a great tool to have in your tool belt. There's a lot of different ways to do everything, and doing one way is, I don't know, it's short-sighted. You need to be doing a lot of different ways in order to optimize everything you can possibly do.
And it's really huge in estate planning, and especially if you get it ahead of time, right? Like I've got some clients, for example, that might have a real estate property, and they want, one of their kids wants the property, and the other kid doesn't really want the property, but they want to leave their kids something, right? If they leave one kid with the property, the other kid needs something. If you don't have a lot of cash to give them, then if you get a whole life policy and balance out the estate, then that's how it's done, right? So your policy bypasses your estate, goes straight to your beneficiary, everything's kept confidential, doesn't go on your will or anything like that. So it's a really good way to balance things out that way. You leave your business to one kid and a whole life policy to the other.
Yeah, and I know for cost-wise, the whole life is more expensive than the term, but the reason is it gets paid out no matter what, because it's whole life. You'll eventually die. And
absolutely,
a term doesn't necessarily even ever pay. It expires, right?
Right. So your term is really protecting yourself against that risk in the next 10, 20 years, right?
Yeah.
When you've got a family growing, you have some young kids, and it would be really tragic if one of you were to pass away, right? So you're protecting yourself against that risk. It's definitely not an investment in that sense, but it can make a huge difference in someone's family. I'm sure you've known somebody, in your circle or an acquaintance that's had a tragedy happen to them like that, and a whole life policy, or not a whole life policy, a term policy would make a big difference there, and just allow them to stay in their home and maintain their lifestyle.
If someone wanted to find more information about this, where would they go?
So they should go to their financial advisor if they've got one already. If you don't, I really recommend you get an advisor, somebody that you talk to at least once a year, give them an update on your whole financial plan, what your goals are, what your investments are like, where they should be like, do you have insurance? So really just get an advisor. If you don't have one, just shoot me a message. My number is 807-620-6590, and we'll put my email in the show notes as well. And so I work out of Thunder Bay, but I do travel to Southern Ontario for work. I'm going there in the fall, actually, for our real estate conference there for Ontario landlords. So that should be pretty fun.
Oh.
Are you going to that one?
I will see you there, yeah. Just to give another self-plug for Dominic, it's good to find someone, if you're in a real estate, if you're doing real estate investing and you're looking for a financial advisor, I would advise to find a financial advisor that does real estate investing as well, so that they have the same mindset and they can put your stuff together the same way. So I would say get Dominique or get someone who is in real estate investing as well, because it's just helpful, because sometimes they don't have the same perspective at all, because they're going to just sell you what they sell you.
That's right. There's all kinds of people in the industry, and find someone that has similar goals to you and that actually has the knowledge to back it up, right?
All right. Thanks for coming on the show, Dominic.
All right. Thanks a lot.